Welcome, my friends. Big news from Silicon Valley this morning. Silicon Valley Bank has been shut down by federal regulators. The FDIC said in the announcement that insured depositors will have access to their deposits no later than Monday morning. For those of you unfamiliar, the FDIC is the Federal Deposit Insurance Corporation. It exists to protect depositors in cases where banks fail, like in the case of Silicon Valley Bank. Silicon Valley Bank's branch offices will also reopen at that time. But they will be under the control of the regulator. The FDIC's standard insurance covers up to $250,000 per depositor, per bank, for each account ownership category. Silicon Valley Bank is a commercial bank that primarily serves the very important economic sectors: technology, life science, healthcare, energy, as well as private equity and venture capital firms. The bank was founded in 1983 in Santa Clara, California. Silicon Valley Bank has since become a leading financial institution, especially for startups and innovative companies in the United States and globally. What does it mean for the economy? And what does it mean for the future of the United States? But before we get into all of that, please press the like button and leave us a comment below. We would love to hear from you. Please subscribe and hit the bell icon so that you are notified of upcoming videos when they are released. Silicon Valley Bank offers a range of financial services, including commercial banking, investment banking, asset management, wealth management, and international banking. The bank's focus on technology and innovation. It has helped it develop specialized services tailored to the unique needs of startups and emerging companies, lending and credit facilities, payment and treasury management, and investment and advisory services. Silicon Valley Bank also provides valuable resources to its clients, including networking events, educational programs, and market research. The bank has established partnerships with leading technology and venture capital firms. Its global network includes offices in the United States, Europe, and Asia. Overall, Silicon Valley Bank has become a trusted partner for startups and innovative companies looking to grow and scale their businesses. Its specialized focus on technology and innovation. It has combined this with its extensive expertise and resources. Silicon Valley Bank has become a unique and valuable player in the banking industry. Well, that was yesterday. Today, financial regulators have closed Silicon Valley Bank and taken control of its deposits. The Federal Deposit Insurance Corp. Announced Friday, leaving companies and wealthy individuals largely tied to the tech sector unsure of what will happen to their money. The California Department of Financial Protection and Innovation closed Silicon Valley Bank and named the FDIC as the receiver. The FDIC in turn has created the Deposit Insurance National Bank of Santa Clara, which now holds the insured deposits from Silicon Valley Bank. The FDIC said in the announcement that insured depositors will have access to their deposits no later than Monday morning. Silicon Valley Bank's branch offices will also reopen at that time, under the control of the regulator. The FDIC also said Silicon Valley Bank's official checks will continue to clear. The FDIC's standard insurance covers up to $250,000 per depositor, per bank, for each account ownership category. It is unclear exactly how larger accounts or credit lines for companies will be impacted by the closure. The FDIC said it will pay uninsured depositors an advanced dividend within the next week. As of the end of December, Silicon Valley Bank had roughly $209 billion in total assets and $175.4 billion in total deposits, according to the press release. The FDIC said it was unclear what portion of those deposits were above the insurance limit. Silicon Valley Bank was a major bank for venture-backed companies, which were already under pressure due to higher interest rates and slowdown for initial public offerings. The closure of Silicon Valley Bank would impact not only the deposits, but also credit facilities and other forms of financing. The FDIC said loan customers of Silicon Valley Bank should continue to make their payments as normal. The move represents a rapid downfall for Silicon Valley Bank. On Wednesday, the bank announced that it was looking to raise more than $2 billion in additional capital. That comes after suffering a $1.8 billion loss on asset sales. The shares of parent company Silicon Valley Bank Financial Group fell 60% on Thursday. Then, they dropped another 60% in pre-market trading on Friday before being halted. A rapid outflow of deposits was complicating the recapitalization process. There seems to be a lot of financial turmoil in Silicon Valley these days. If you recall, it was just a year ago when SPACs were all the rage. SPACs are also known as blank check companies. They typically have no operations or revenue at the time of their IPO. Instead, they raise funds from investors through the sale of units. This typically consists of one share of common stock and a fraction of a warrant to purchase additional shares at a later date. The funds raised from the IPO are held in a trust. That continues until the SPAC identifies a target company to merge with or acquire. Once a suitable target is identified, the SPAC will negotiate the terms of the merger or acquisition. The next step is for the SPAC and the target company will merge or be acquired. At that point, the combined entity will become a publicly traded company. SPACs have become increasingly popular in recent years. Some might have called it a SPAC fad. Some investors speculated that they provide an alternative way for private companies to go public. This is seen as a way to sidestep having to go through the traditional IPO process. Because there have been cases of SPAC bankruptcies or liquidations. While SPACs are designed to merge with or acquire a private company and take it public. Not all SPACs are successful in doing what they set out to do. Some SPACs may struggle to find a target company to merge with or acquire. Or they may encounter other challenges that prevent them from completing a successful transaction. In some cases, a SPAC may have to return the funds raised in its IPO to investors. That normally happens if it is unable to identify a suitable target company within a specified period of time. This is known as a SPAC liquidation. In other cases, a SPAC may acquire a target company that later runs into financial difficulties. That normally leads the combined company's bankruptcy. For example, in 2020, electric truck maker Lordstown Motors merged with a SPAC called Diamond Peak Holdings. But the combined company later faced financial challenges that raised concerns about the company's viability. In 2021, Lordstown Motors announced that it was running low on cash. It told investors that it could go out of business if it did not raise additional funds. The Great SPAC crash basically ended 2022 in dramatic fashion. December witnessed a record flurry of liquidations. Lots of shareholders cashed out of the speculative investing industry for good. That included at least 80 special-purpose acquisition companies. These companies raised $24 billion in total. And they face a wall of investor meetings. These meetings will give investors the chance to bail. That comes out ahead of a new U.S. tax that could hurt their returns. At least 32 SPACs holding roughly $18 billion are looking to close up shop. They could return capital over the coming 2.5 weeks. The latest headache for the blank check industry is a potential 1% excise levy. This new law could affect stock repurchases and buybacks. It is part of President Joe Biden's Inflation Reduction Act. And if you follow this channel, you know that the Federal Reserve is aggressively raising interest rates. That is resulting in falling share prices. And this is darkening the climate for acquisitions and mergers. It also puts companies with weak balance sheets in danger. For firms that went public, an astonishing 96% of shareholders elected to redeem their stock on average. Now, rampant redemption rates are hitting the SPAC industry. And it is hindering the industry's ability to get deals done. A new tax law has pushed dozens of blank check sponsors to liquidate early. Many are simply choosing to give investors a chance to get out ahead of the law's implementation. SPACs were ensnared in the law's effort to rein in the frenzied pace of share repurchases. Share buybacks are a key move that public companies use to help boost their value. Many companies would rather invest the extra revenue in the business or paying higher dividends. And things could get even worse. And, if you follow this channel, you probably already know that tech companies are sensing weak macroeconomic conditions. Inflation is raging in most parts of the world. Central banks are aggressively raising interest rates in order to tame inflation. Consumers' budgets are getting tighter because of having to spend more on gas and food. So, consumer discretionary spending is weakening. Corporate marketers are cutting their ad budgets, especially online. And ad revenue is the lifeblood of many big tech companies. Layoffs at big tech companies are big news because the biggest tech companies went on a veritable hiring spree throughout the pandemic. But the United States is now teetering on the brink of recession and the digital ad market has plunged. But, what do you think? Please leave us a comment below and hit the like button. We would love to hear from you. Please subscribe and hit the bell icon so that you are notified of upcoming videos when they are released. Please share this video on social media. Thank you for watching.